Welcome back to the deep dive. Today, we are immersing ourselves in the world of solid waste management. It's arguably, the least glamorous yet maybe the most essential industry out there.
Absolutely essential. Can't live without it.
Exactly. And our target today is Waste Connections, Inc., ticker WCN. Now, they're the third largest player in North America, but here's the puzzle, right? How does a company in what seems like a basic sort of commodity sector.
Right, picking up trash.
Yeah, how do they consistently pull off financial results, profitability metrics that actually dwarf their much bigger rivals, Waste Management and Republic Service? That's the core question.
It really is.
Yeah.
Because, on the surface, waste management looks pretty straightforward. It's defensive. It's non-cyclical. It's a utility, basically.
Investors like stable.
They love stable.
Yeah.
But WCN isn't just stable. They're not just surviving. They are actively thriving by following a very, very different path. An explicitly differentiated strategy. So the investment thesis here isn't just, hey, they're in a necessary business. It's that they've built something structurally superior, a business model that's highly defensible, you could say.
A blueprint, maybe.
A blueprint for margin supremacy, yeah. That's a good way to put it. And it leads directly to industry-leading profitability, better returns on capital. They chose to compete differently, and, well, the numbers kind of prove they were right.
So our mission today is to unpack that unique formula. We're going to dig into the strategic calls they made, like market selection, why they avoid the big cities.
Which is counterintuitive for growth sometimes, right?
It seems like it. And we'll look at their culture, this decentralized, fiercely independent thing they have, and how that actually becomes a financial asset, a quantifiable one.
Culture is a profit driver. It's fascinating.
And then there's the M&A engine. They're aggressive, constantly buying smaller players. How does that work? But crucially, we also have to tackle the risks, because there are big ones right now.
You have to mention Chiquita Canyon. It's unavoidable.
Exactly. That landfill event in California is casting a long shadow. So we'll analyze that fallout, how it's shaping their valuation. This dive should give you the full picture, the good and the challenging.
Okay, let's set the scene first. This North American waste landscape.
Oh.
It's huge, right? Just massive.
Oh, enormous. Depending on how you slice it, including municipal, industrial, specialized stuff, you're looking at estimates anywhere from, say, $210 billion.
Okay.
Maybe up to over $470 billion for 2024. It's a wide range, but...
But the point is, it's vast.
It's vast. And importantly, it's mature. But mature doesn't mean dead. It's got this steady, non-cyclical demand baked in.
People always need their trash collected, recession or boom.
Exactly. You might put off buying a new car, you might skip a vacation, but the garbage truck still has to come. That resilience, that predictability is gold for investors. It means a very dependable revenue stream.
And the growth is still decent, even for a mature market. Yeah, surprisingly robust, actually.
Yeah.
Forecasts are generally in the 4.0% to maybe 5.9% CAGR range. Compound annual growth rate. So steady growth on a huge base.
And within that huge market, where's the real money made? What's the core business?
It's overwhelmingly collection. Think the trucks, the routes. That's over 60% of the market revenue.
Wow. Okay.
So success really boils down to route density, logistical efficiency. How tightly packed can you make those pickups? How little fuel can you burn between stops?
Minimize driving time, maximize collection time.
You got it. That's the fundamental operational nut to crack in this industry, getting those routes perfect.
Okay, so if efficiency is key, how does the market structure play into that? You mentioned the big three earlier.
Right. Waste Management, WM, Republic Services, RSG, and our focus today, Waste Connections, WCN. It really operates like a de facto oligopoly in the public markets.
Why only three big ones? Why hasn't someone else jumped in, given the size?
Barriers to entry, they're exceptionally high, like sky high.
Okay, break that down. What kind of barriers?
Well, first, just the sheer capital needed. You need hundreds of millions, easy, for a fleet of specialized trucks, maintenance depots, transfer stations where waste is consolidated.
Sophisticated sorting facilities for recycling.
Exactly. All that infrastructure costs a fortune. But honestly, that pales in comparison to the real barrier.
Which is?
Landfills. Getting permission, getting permits to build and operate a new landfill. It's become almost impossible in many parts of North America.
Right, the NIMBY problem. Not in my backyard. Nobody wants a landfill nearby.
Nobody. And the process. Oh, man. You're talking 5 to 10 years, minimum, often longer. You've got local opposition, state environmental agencies, federal EPA rules, political hurdles.
It's a minefield.
So even if you had the billions for the physical site,
Getting the permit is the bottleneck. And even then, building a modern landfill with all the environmental liners and monitoring systems required today, the construction cost itself is staggering.
so this makes existing landfill airspace incredibly valuable, more than just dirt in the ground. It's like gold. Think of it as finite real estate with an irreplaceable operating license. The cost to replace that permitted airspace, if you even could, is so astronomically high,
That its strategic value is way more than what's on the books.
miles beyond its depreciated book value. For these big companies, controlling where the waste ultimately goes, that's controlling the market. Disposal access is power.
Okay, and this scarcity, this landfill reality, is the backdrop for WCN's unique strategy, right? They don't chase the biggest markets.
Precisely. This is their foundational decision. They deliberately avoid the huge, hyper-competitive urban centers. Think New York, LA, Chicago.
Isn't that where most of the trash is?
It is, but it's also where competition is fiercest. Pricing gets squeezed. Customers jump between providers more easily. And think about the operational costs.
Traffic, fuel, getting those dense routes is harder.
Exactly. Dense populations, yes, but also dense traffic. It eats away at those crucial route efficiency margins. So WCN said, basically, we don't want to play that game.
So where do they play?
Secondary cities, smaller towns, rural areas, and critically, markets where they can lock up exclusive municipal contracts.
Ah, the exclusivity clause. What does that actually achieve for them economically?
It's huge.
Yeah.
It leads directly to local dominance and much stronger pricing power. If you're the only game in town because you have the city contract.
You can charge a fair price, and customers don't have alternatives.
Right. They achieve overwhelming market share, often becoming a local monopoly effectively, and that means they can implement price increases more consistently. Historically, WCN's price hikes have outpaced inflation. That's a powerful engine for organic growth.
And less customer churn, presumably.
Significantly less. If you're unhappy, where are you going to go? This stability allows them to focus on operations, not just constant customer acquisition battles.
And they layer vertical integration on top of this geographic focus.
Yes, that's the final piece of the moat. They aim to control the waste stream from curb to landfill. They want to own the collection routes, the transfer stations, and most importantly, their own strategically located landfills.
Why is owning the landfill so critical if they already have market share?
Transportation costs. Outside of labor, hauling waste is the single biggest operating expense. If WCN owns a landfill that's, say, 50 miles closer to their collection routes than the nearest competitor's disposal site,
Their hauling costs are dramatically lower.
dramatically, it creates a massive cost advantage.
Okay.
Even if a smaller competitor tries to undercut them on the collection price, that competitor might have to truck the waste hundreds of extra miles. Their margins get destroyed.
So owning the nearby disposal site locks in the local advantage.
It makes them incredibly difficult to compete against in your chosen markets. It's a self-reinforcing system. Niche markets, exclusive contracts, vertical integration, especially landfill ownership. That's the competitive mode.
Okay, so the strategy makes sense. Niche markets, pricing power, controlling the waste stream. But, strategy on paper is one thing. Execution is everything.
Couldn't agree more. And this is where WCN's operating model, specifically their culture, really stands out. They claim it's a quantifiable financial asset.
How so? What's different about how they run things?
Well, unlike the giants, WM and RSG, which tend to be very centralized, often quite bureaucratic, WCN operates on a highly decentralized model.
Decentralized, meaning decisions are made lower down.
Much lower down. They empower their local and regional managers with significant autonomy. Pricing decisions, route scheduling, fleet maintenance choices, even identifying and pursuing small local acquisitions. A lot of that happens at the local or regional level.
And they call this servant leadership. Sounds a bit management speak.
It does sound a bit like a textbook term, I agree. But in practice, it's about enabling those local leaders. Think about it. In a big centralized company, a local manager might spot an opportunity, say, a new housing development popping up.
Right. Needs service quickly?
Exactly. But in a centralized system, they might have to send a proposal up the chain, wait for regional approval, then maybe corporate budget allocation. It could take weeks.
And by then, the opportunity's gone, or a competitor stepped in.
Precisely. But under WCN's model, that local manager, empowered with P&L responsibility for their area, can often assess the need, maybe pull budget for an extra truck from their regional allocation, adjust pricing, and sign the contract fast. Sometimes the same day.
That agility has to translate to the bottom line.
Directly. It keeps overhead low, because you don't need massive central planning departments dictating local operations. It keeps them nimble, responsive to local market conditions. It contributes significantly to that margin supremacy we talked about. Decisions are faster, better informed by local realities.
And this decentralized agile structure then feeds into their M&A strategy. You said they focus on smaller private companies.
Yes, and this is where the culture becomes a powerful, almost unfair advantage in deal-making.
How does culture help close deals? Usually it's about the price, right?
Price matters, of course. But think about who they're buying. Often it's multi-generational, family-owned businesses, successful ones. These owners care deeply about their company's legacy, their employees, their local brand name.
They built it from scratch, or their parents did.
Exactly. So when a giant, centralized competitor comes knocking, the offer might be financially attractive, but the seller often worries, are they just going to swallow us whole? Will our name disappear? Will our people be forced into some rigid corporate structure?
They fear losing their identity.
Completely. Then WCN comes along. Their pitch is different. They say, look, we operate decentralized. Your local managers, your team, they'll likely stay in place. They'll keep making local decisions, running the business, much like they do now, just with access to our capital, our disposal network, our back office support.
So continuity and local autonomy are part of the offer.
A huge part. For many family sellers, that promise of preserving the local operation and taking care of their people is incredibly appealing. It often makes WCN the preferred buyer. Sometimes, even if their financial bid isn't the absolute highest, it's a cultural moat that directly fuels the M&A pipeline.
That's fascinating. So the operating model enables the M&A, and the M&A fuels the growth. It's a loop.
A beautiful self-reinforcing feedback loop. And they know how valuable this culture is. They actively work to maintain it. You saw that with the return of the founder, Ron Middlestate, as CEO in April 2023.
They called it a year of renewal.
Right. It was explicitly about reinforcing that core servant leadership culture, making sure it hadn't gotten diluted as they scaled up. They knew it was key to their success.
And did that renewal have tangible results beyond just feeling good?
Oh, yeah. Hard numbers. Over the next 2 years, they saw voluntary employee turnover, people choosing to leave, drop by an incredible 45%.
45%? That's huge in an industry with high turnover.
Massive. And safety incidents fell by over 20%.
Okay, connect the dots for us. How does lower turnover and better safety translate directly to financial performance?
It's not soft stuff at all. Lower turnover slashes costs. Think recruitment expenses, training new drivers and mechanics, which is expensive and time-consuming getting them certified, the ramp-up time. All that costs real money. Cut turnover by 45%, you save millions.
And safe.
Fewer accidents mean lower insurance premiums, fewer workers' comp claims, less equipment downtime for repairs, fewer potential regulatory fines, better community relations. It all adds up. Management is very clear. These cultural improvements in turnover and safety are directly linked to stronger financial execution and better margins. Culture isn't just talk, it's a financial lever.
All right, let's get into the hard numbers then, the proof in the pudding, so to speak. And you mentioned margin supremacy. How much better are WCN's margins, really?
Consistently the best among the large cap players. And this isn't a blip, it's a persistent gap. The key metric here is adjusted EBITDA margin, basically. Operating profit before interest, taxes, depreciation, and amortization, adjusted for certain items. It shows core operational efficiency.
Okay, what was the number for 2024?
For 2024, WCN hit 32.5%.
32.5%? How does that compare?
It compares very favorably. Republic Services, RSG, came in at 31.1%. Waste Management, WM, their core legacy solid waste business margin was around 30.0%.
So WCN is running about 1.4 percentage points higher than RSG and a full 2.5 percentage points higher than WM. That's significant in a business like this.
It's a huge difference when you apply it across billions in revenue. And what's more, that gap has actually been widening. WCN managed to expand its margins by 200 basis points between 2020 and 2024.
200 basis points. That's 2 full percentage points of improvement.
Correct. A basis point is just 0.01%. So 200 basis points is 2%. Even while dealing with inflation and economic pressures, they improve their core profitability relative to revenue. It's direct, quantitative proof that their strategy, the niche markets, the pricing power, the operational model simply works better financially.
Okay, so superior margins.
Yeah.
How do they generate the growth that the market wants to see? You mentioned a dual engine model.
Right. Two main levers. Lever one is price-led organic growth. This comes straight from that market dominance we discussed.
The exclusive contracts, the local monopolies.
Exactly. It gives them defensible pricing power. In 2024, they achieved solid waste core price growth of 7%. That's well ahead of general inflation in many areas.
7% price increases, that's strong.
Very strong. And management is quite disciplined about it. They talk about making a purposeful price-volume trade-off,
Meaning?
meaning they're willing to lose some volume, maybe walk away from a lower margin contract if it means maintaining overall profitability. They prioritize profitable revenue over just chasing sheer size or volume. That focus protects the high margins.
Okay, so pricing is lever one. What's lever two?
Lever two is acquisition growth, M&A. This is the engine for the outsized growth, the part that really moves the needle beyond just organic expansion.
And 2024 was a big year for that.
A record year. They deployed a staggering $2.2 billion on acquisitions in 2024.
$2.2 billion. For a company their size, that's massive.
It's huge. And those deals weren't just for show. They contributed $529 million to the 2024 revenue line. So immediate impact.
Any notable deals in that bunch?
Yeah, a strategically important one was acquiring Secure Energy's waste disposal assets. This wasn't typical trash. It was focused on the specialized E&P segment, exploration and production waste, mostly from the energy sector.
Ah, the R360 business we'll touch on later.
Exactly. And that specific acquisition is projected to give a massive boost, like 67% growth uplift to that specialized E&P waste segment. So very targeted, high-impact M&A.
Okay, strong margins, strong growth from price and M&A. This must generate a ton of cash.
It absolutely does. The business model is a fantastic generator of predictable, recurring cash flow. Net cash from operations reached $2.23 billion in 2024.
$2.2 billion in cash from just running the business.
Yep. But what's arguably even more impressive is how efficiently they convert their earnings into actual cash they can use. We look at free cash flow, or FCF, conversion.
Remind us, what's free cash flow again?
FCF is the cash that's left over after they've paid all their operating expenses and made the necessary investments back into the business, the capital expenditures, or CapEx, for trucks, landfills, facilities. It's the real deployable cash they can use for M&A, paying dividends, buying back stock, or paying down debt.
Got it. So how good is WCN at converting earnings to FCF?
Very good. In 2023, they converted 48.5% of their adjusted EBITDA into adjusted free cash flow. Almost half of their operating profit became readily available cash. That shows incredible discipline in managing spending and collecting receivables. It's a sign of a highly efficient operation.
Okay, but here's where I push back a little. Spending $2.2 billion on acquisitions in 1 year, that sounds inherently risky. Doesn't that blow up the balance sheet? Doesn't leverage spike?
That's the perfectly logical question to ask. Aggressive M&A can be very risky. Integration challenges, overpaying, taking on too much debt. It trips up a lot of companies.
So how did WCN manage it without leverage getting out of control?
Well, despite spending that record $2.2 billion, their key leverage ratio, net debt to adjusted EBITDA, barely budged. It went from 2.60 times at the end of 2023 to only 2.67 times at the end of 2024.
Wait, only up by 0.07x. After spending billions, how is that even possible? That seems like dynamic deleveraging, almost in real time.
That's a great term for it. It's not magic, though. It relies on two core things happening simultaneously. First, the companies they buy have to be high quality and immediately accretive.
Meaning profitable and generating cash flow right away?
Exactly. WCN is very disciplined in targeting companies that fit their high-margin, low-competition profile. They don't buy junk just to get bigger. Second, it comes back to that powerful FCF conversion we just talked about.
The cash machine.
Right. They generate so much internal cash flow, and the newly acquired businesses start generating cash flow immediately, that they can essentially use this combined fire hose of cash to pay down the acquisition debt incredibly quickly.
So they can digest these big deals much faster than others might.
That's the competitive advantage. Their ability to rapidly deleverage after acquisitions gives them the financial agility to keep doing deals, to stay aggressive in consolidating those fragmented secondary markets. While other companies might have to pause and repair their balance sheets, they reload faster.
Okay, it sounds like a very well-run operation with a strong strategy. But no company is without risks. And WCN has a big specific one right now. The Chiquita Canyon landfill event. What exactly is going on there?
Yeah, Chiquita Canyon is a major headache, the large landfill in California, and it's experiencing what's called an elevated temperature landfill event, or ETLF.
Elevated temperature, what does that mean practically?
It means there's a subsurface reaction happening within the buried waste. It's complex, involving chemical and biological processes that cause the temperature deep inside the landfill to rise significantly, much higher than normal decomposition.
And that causes problems.
Big problems. It generates excessive Noxious odors, which is a huge community relations issue. It can cause gas migration issues and potentially instability within the landfill structure itself. It's basically an underground fire, but without flames, that's very difficult and expensive to manage. A real operational crisis.
And the financial impact has been severe.
Very severe. It's important here to separate the accounting charge from the actual cash cost, though.
Okay, good distinction. What was the accounting hit?
In the fourth quarter of 2024, they took a massive non-cash impairment charge of $601.6 million related to Chiquita Canyon.
$600 million. But non-cash means?
It means they wrote down the value of the asset on their balance sheet, recognizing its future earning potential was permanently damaged. Money didn't actually leave the bank for that specific charge.
But there were real cash costs, too.
Oh, yes. On top of the impairment, WCN spent over $200 million in actual cash during 2024 alone. That was for remediation efforts, trying to control the reaction, extensive environmental monitoring, operational fixes, legal fees, dealing with regulators, and community lawsuits. Yeah. Real money going out the door.
And ultimately, they decided they couldn't fix it.
They made the tough call to permanently close the landfill to receiving new waste as of January 1st, 2025.
So the immediate operational bleeding stops, but what's the lingering impact?
Well, losing a large, profitable landfill like Chiquita Canyon isn't trivial. Management expects it to create about a 20 basis point headwind to their overall company margins going forward. That's 0.2%. Right. Plus, the closure doesn't mean the costs disappear entirely. They still face potentially years of ongoing remediation work, long-term monitoring, potential regulatory fines, and significant litigation risk from the community and environmental groups. Those future costs will continue to be a drain on that free cash flow we talked about.
So, Chiquita Canyon is a material, ongoing risk factor investors need to watch closely. It's a blemish on their usual operational excellence.
Absolutely. It's the single biggest acute risk they face right now. But beyond that specific event, there's also broader economic sensitivity, even in the waste business.
Right. You said core collection is defensive, but not all their revenue is. Which parts are more cyclical?
Primarily, it's anything tied to construction and heavy industry. Think about their roll-off services, those big open-top dumpsters you see at construction sites.
Yeah, for C&D debris, construction and demolition.
Exactly. When new home building slows down or commercial construction pauses, the demand for those roll-offs drops pretty quickly. It's a leading indicator almost.
And industrial waste.
Same story. Special waste volumes from manufacturing plants, factories, industrial sites. If those sectors slow down, they produce less waste. And WCN handles less of that higher margin special waste.
And then there's that energy sector exposure through our 360 Environmental Solutions, the oil field waste business. That must be inherently volatile.
It's extremely volatile. It handles non-hazardous waste from drilling and production, things like drilling muds, contaminated soils. When oil prices are high and drilling activity is booming, our 360 can be very profitable, often with high margins because it's specialized.
But when oil prices fall or drilling budgets get slashed,
our 360's volumes can fall off a cliff pretty quickly. It's directly tied to the cycles in the energy market, which can swing wildly. Management actually mentioned recently that they were seeing some sluggishness in these more cyclical parts of the business.
What does that suggest about the broader economy?
It suggests WCN is currently operating in a flatter, maybe slightly softening economic environment, not a booming cyclical peak. If the economy were red hot, these segments would likely be doing much better.
Okay, one more risk area. Commodity prices. How exposed are they?
Increasingly exposed, actually. Traditionally, it was mostly about the prices they get for recycled materials, cardboard, OCC, mixed paper, plastics, metals. Those prices fluctuate based on global demand.
Right, the value of recyclables goes up and down.
Exactly. But now, as they invest more heavily in waste to energy, particularly renewable natural gas, RNG from landfills,
they're exposed to energy commodity prices, too.
Yes. They become exposed to the market price for natural gas and also the value of renewable identification numbers, or RINs. Those are the credits generated under renewable fuel standards.
So if RIN prices drop or natural gas prices fall,
it directly impacts the profitability of those RNG projects. Management actually highlighted this risk specifically, noting about a 15% drop in overall commodity values after Q3 2024, which impacts their realized margins from both recycling and these newer energy initiatives. It adds another layer of volatility.
All right, so we have the ongoing Chiquita issue and some cyclical headwinds. But looking forward, the core growth story still seems to rely heavily on that M&A engine. Is there still enough runway? Are those secondary markets still fragmented enough?
Management seems very confident that the runway is still long. those secondary and rural markets that WCN specializes in, they remain highly fragmented compared to the big urban centers. There are still hundreds, probably thousands, of smaller, private, often family-owned haulers and disposal sites out there.
The exact type of companies their decentralized model appeals to.
Exactly. So the pipeline of potential deals remains robust. They're not running out of targets yet. In fact, they've guided that they expect to close another $100 million to $200 million worth of these tuck-in acquisitions by early 2026.
So deal flow looks solid. M&A continues to be the primary driver for that outsized growth.
Correct. Organic growth from pricing is solid, but the big step-ups in revenue tend to come from successful M&A integration.
Now, beyond just buying traditional waste assets, you mentioned they're leaning into sustainability, the circular economy as a profit center. Tell us more about that.
Yeah, this is a really important strategic shift you're seeing across the industry. But WCN seems particularly focused on making it pay. They don't view ESG, environmental, social governance, as just a cost of doing business or a PR exercise.
They see it as a source of value creation.
Exactly. The prime example is the big investment in renewable natural gas, the RNG facilities at their landfills.
Right, capturing the methane.
Right. Landfills naturally produce methane as waste decomposes. Methane is a potent greenhouse gas, so it's an environmental liability they have to manage anyway, by capturing it, cleaning it up to pipeline quality.
They turn a liability into an asset.
Precisely. They create a valuable, marketable, commodity clean energy that also generates those valuable RIN credits. It's smart business. They're effectively monetizing something that used to be purely a cost or a risk.
And their environmental goals reflect this seriousness.
I think so. They hit their initial goal of reducing greenhouse gas emissions by 15% and then immediately double down, setting a new target of 30% reduction. That suggests a real long-term commitment, likely driven by the potential profitability of these green technologies.
Okay, so they have organic growth, M&A growth, and this emerging sustainability RNG growth vector. With all the cash flow this generates, how do they decide where to put the money? What's the capital allocation philosophy?
They're very clear and disciplined about their priorities for deploying that free cash flow. It follows a distinct hierarchy.
What's number one?
Number one, top priority, is M&A. Reinvesting back into the business through acquisitions that fit their strategic model. That's seen as the highest return use of capital for driving growth and margin expansion.
Makes sense given their track record. What's next?
Priority number two is returning cash to shareholders via dividends. And they have a truly stellar track record here. We're talking 14 consecutive years of double-digit percentage increases to their dividend payout.
14 years of 10% or more increases. That's impressive consistency.
It really is.
Yeah.
It signals strong management confidence in the stability and future growth of their cash flows. They raised it another 10.5% in 2024. Shareholders love that kind of a predictable, growing income stream.
Okay, M&A first, dividends second. What's the third priority?
The third lever is opportunistic share repurchases, or buybacks. They have authorization under what's called a normal course issuer bid, NCIB, to buy back their own stock in the open market.
And they use this when?
They tend to be opportunistic. They'll be more active with buybacks if they feel the market is undervaluing the stock, perhaps due to temporary headwinds or just general market conditions. They were actively repurchasing shares in Q2 2025, for instance. It's a way to return excess capital to shareholders and boost earnings per share when M&A opportunities aren't as compelling or the stock looks cheap.
So a clear, disciplined, three-tiered approach. M&A, dividends, then buybacks.
Exactly. And this framework seems to give management confidence heading into 2025. Their guidance reflects continued optimism.
What are they projecting for 2025?
They're guiding for revenue in the range of $9.45 billion to $9.60 billion. So continued solid top-line growth.
And margins, despite the Chiquita headwind.
Yes, this is key. Even with that 20 basis point drag from Chiquita, they are projecting further adjusted EBITDA margin expansion. They expect to add another 50 basis points, taking the overall margin to a new record high of 33.0%.
Wow, hitting 33% margin would be quite an achievement.
It would underscore the strength of the core business and their ability to manage costs and pricing. And finally, they expect normalized adjusted free cash flow, that deployable cash, to exceed $1.55 billion in 2025. That's the fuel that keeps the whole engine running.
All right, let's talk valuation. Because if the strategy is superior, the margins are higher, the growth is strong, and the cash flow is robust. The market probably knows this, right? They likely traded a premium.
Oh, absolutely. WCN consistently commands a significant premium valuation multiple compared to WM and RSG. It's not even close, really.
How much of a premium are we talking? Give us some numbers.
Okay, let's look at a common metric. The price to earnings, PE ratio, based on trailing 12 months earnings. WCN currently trades around 51.8 times earnings.
52 times earnings. That's high for almost any industry, let alone waste management.
It is high. Now, compare that to waste management and Republic Services. They typically trade in the low to mid-30s PE range. So WCN is getting a multiple that's maybe 50–60% higher than its larger peers.
Does that premium hold on other metrics too, like forward-looking ones?
Yes, it does. Look at forward enterprise value to EBITDA. EBITDA. That's a common one analysts use because it includes debt. WCN trades around 20 times forward EBITDA.
And the peers?
WM and RSG are closer to 16 or 17 times. So again, a noticeable premium for WCN, around 15–20% on that metric. This isn't a fluke. It's a consistent pattern.
So the big question, is that premium justified? Why is the market willing to pay, say, 20 times EBITDA for WCN when they could buy the bigger guys for 16 or 17 times?
The argument for justification rests on three pillars, really. One, superior profitability, those consistently higher margins we've been discussing. Two, historically stronger revenue growth, driven largely by that successful, disciplined M&A strategy. And three, the perceived defensibility and quality of those earnings.
Meaning the niche market strategy makes their earnings more reliable.
That's the idea. Because they operate with less competition in their core markets, have strong pricing power, and benefit from vertical integration, the market believes their earnings stream is less volatile and higher quality than peers fighting it out in hyper-competitive urban areas. You're paying a premium for that perceived lower risk and higher operational excellence.
Okay. Our sources also mentioned a discounted cash flow analysis, a DCF model, to try and estimate intrinsic value. What did that suggest?
The DCF base case pointed towards an implied share price around $203. Now, of course, DCF is highly sensitive to assumptions.
Always is. What were the key assumptions driving that $203 number?
It basically assumed WCN continues executing its current strategy successfully. So revenue growth projected in the 6% to 8% range annually for the next 5 years or so, before tapering down to a more standard terminal growth rate of about 2.5%.
And margins.
Assumed continued gradual margin expansion driven by pricing and efficiency gains, reaching maybe 33.5% over that 5-year forecast period. Essentially, the DCF reflected expectations that WCN will keep outperforming its peers operationally.
And is management incentivized to deliver that kind of long-term performance?
It appears so. Their executive compensation structures seem pretty well aligned with long-term shareholder value. Bonuses and stock awards are tied to metrics like the compound annual growth rate of adjusted free cash flow per share, which encourages smart capital allocation, not just empire building.
And return on invested capital, ROIC.
Yes, improving ROIC is another key metric. They even have ESG targets factored into compensation now. So the incentives seem designed to reward high-quality, profitable growth over the long haul. Hashtag tag outro.
Okay, so let's try and wrap this up. If we synthesize everything we've discussed, the key takeaway seems to be that Waste Connections isn't just another garbage company. It's really a platform built on strategic differentiation.
Right, deliberately choosing not to compete head-on with the giants everywhere.
Exactly. They pick their battles, secondary markets, exclusive contracts, and they combine that with this unique, decentralized servant leadership culture, which sounds soft, but actually acts as a tangible financial asset, driving efficiency and enabling their M&A.
It systematically generates those higher returns. The culture is inseparable from the financial results.
So it's a highly resilient, very profitable machine with significant competitive moats, particularly that landfill control and vertical integration.
But you have to balance that. As we discussed, the Chiquita Canyon situation is a serious ongoing risk, both financially and reputationally, and parts of their business are sensitive to the economy. Those factors need constant monitoring. However, on balance, the strategic advantages, the operational excellence, and the disciplined capital allocation, it really does seem to justify why the market consistently awards WCN that premium valuation. They've built a better mousetrap, so to speak, in a necessary industry.
All right, that brings us to our final provocative thought for you, the listener, to chew on after this deep dive. We spent a lot of time talking about how valuable existing permitted landfill airspace is right now. Scarcity makes it almost priceless because getting new permits is so incredibly
A
hard.
huge moat currently.
But think about the long-term trend, the massive push towards the circular economy, diverting waste from landfills, and especially the big investments WCN and others are making in waste energy technologies like RNG, turning methane liability into a valuable fuel asset.
Right, extracting value before disposal.
So here's the question. If these technologies become widespread and highly efficient over the next decade or two, does that fundamentally change the core intrinsic value of developing new landfill capacity? If the goal shifts from simple disposal to maximum resource recovery and energy generation, does the scarcity premium purely on disposal space start to erode for these giants?
Hmm. A fascinating tension. Does today's scarcity moat get technologically disrupted tomorrow? That's a huge strategic question for the entire industry's future.
Something to think about. Thanks for diving deep with us.